In 2019, a quantitative analyst from Goldman Sachs walked away from a six-figure salary to trade full-time. He had two master's degrees, one in mathematics and another in financial engineering. He'd built risk models that handled hundreds of millions of dollars. Within 18 months of trading his own account, he'd lost $180,000. This wasn't a story of ignorance. It was a story of intelligence becoming a weapon against itself. If you're watching this, there's a good chance you're smart, maybe really smart. You understand market structure. You can explain why central bank policy affects currency pairs. You've read the books, watched the courses, back-tested strategies. And yet, your account tells a different story. Here's what nobody tells you. Your intelligence isn't failing you in trading. It's working exactly as designed. The problem is that the same cognitive gifts that make you successful everywhere else become liabilities in the market. And until you understand why, you'll keep losing to traders who know less than you, but make more than you. Let's start with something that might sting a little. Smart people are used to being right. Your entire life has been a validation loop. You studied hard, you got good grades. You solved complex problems at work, you got promoted. You analyzed situations, made logical decisions, and things worked out. Your brain has been rewarded thousands of times for thinking harder, analyzing deeper, and outsmarting the room. Then you come to trading, and that same approach destroys you. Meet James. He was a senior software engineer at a major tech company, the guy everyone came to when something was broken and nobody else could figure it out. Debugging systems with millions of lines of code was his specialty. When he started trading, he approached it the same way he approached code: find the pattern, understand the logic, execute the solution. He spent 6 months building a trading system, back-tested it across 5 years of data. The equity curve was beautiful, risk-reward was perfect, win rate was 68%. He was so confident he quit his job. 3 months later, he'd broken every rule in his system. He was overtrading, revenge trading, and moving his stop losses. The system still worked. His intelligence hadn't failed him there. But his intelligence had convinced him that he could outsmart his own rules in real time. After all, he was smart enough to build the system. Surely he was smart enough to know when to break it. That's the first trap. Intelligence creates confidence in your ability to think your way out of anything. But trading isn't a problem you solve with more thinking. It's a game you win by thinking less at the exact moments your brain is screaming at you to think more. Here's the uncomfortable truth. The market doesn't care about your IQ. It doesn't reward complex analysis. Some of the most profitable traders I've ever studied use systems so simple they could teach them to a 10th grader. Meanwhile, some of the smartest people I know are sitting on blown accounts, convinced that if they just think harder, analyze deeper, find one more edge, everything will click. But here's what actually happens. Your intelligence gives you 3 specific traits that work everywhere else but backfire in trading. Number 1. Pattern recognition on steroids. Smart people are exceptional at finding patterns. Your brain's a pattern-matching machine that's been highly trained. In most areas of life, this is incredible. You see connections others miss, you predict outcomes before they happen. In trading, this becomes a curse, because the market is full of noise masquerading as patterns, and your intelligent brain will find those patterns whether they exist or not. You'll see a setup that looks like the one from last week. You'll notice the market tends to bounce at a certain level. You'll create narratives about why price should do something. And you'll be so convinced by your own analysis that you'll ignore the reality unfolding in front of you. I watched a trader named Sarah, a former data scientist, lose $40,000 in 3 months because she kept finding confirmation of her bias in the charts. Every time the market moved against her, she'd find another indicator, another time frame, another piece of data that suggested she was right and the market was just delayed. Her intelligence gave her an infinite toolkit to justify staying wrong. Number 2. The need to understand why. This one kills more smart traders than almost anything else. You're used to understanding cause and effect. You need the why before you act. It's what makes you good at your job, good at solving problems, good at life. But the market doesn't owe you a why. Price moves, and most of the time, the reason doesn't matter. A profitable trader sees their setup, takes the trade, manages risk, and moves on. A smart trader needs to understand why the setup is forming, what's driving the move, whether it makes logical sense. And while they're thinking, the opportunity passes. Or worse, they take the trade but then second-guess it mid-trade because the why changed. Number 3. Ego attachment to being right. When you're smart, being right isn't just a nice outcome. It's part of your identity. You're the person who knows things, who figures things out, who doesn't make dumb mistakes. That's been your role your entire life. In trading, this becomes toxic fast. Because trading isn't about being right, it's about making money. And sometimes making money means taking a loss. It means admitting you were wrong quickly. It means looking stupid on a single trade so you can stay alive for the next one. But your intelligent brain fights this. Every losing trade feels like a referendum on your competence. So you hold losers longer, hoping they'll turn around and prove you were right all along. You skip trades that don't meet your sophisticated criteria because they feel too simple, too obvious. You overcomplicate systems because simple feels like something a smart person wouldn't need. Let me tell you about Marcus. He had a PhD in economics, taught at a university, published papers on market efficiency. When he started trading, he brought 15 years of academic understanding of how markets work. He lasted 8 months before his account was down 70%. Here's what happened. Marcus would enter trades based on sound fundamental analysis. He'd identify mispriced assets, understand the macro factors, build a thesis that would make sense to any economist. And he'd be right about the direction eventually. The problem was the eventually part. The market would move against him short-term, and instead of taking the loss, he'd add to the position. After all, his analysis was sound. The market was wrong, temporarily. He had the intelligence to see what others couldn't, so he'd average down, confident that his superior understanding would be validated. It was validated, sometimes. Price would eventually move in his direction, but by then he'd over-leveraged himself on the averages, and a small move against him would trigger a margin call. Or he'd be so underwater that even when price moved his way, he barely broke even. His intelligence had convinced him that understanding the market meant controlling the market, that being smart about economics meant he could predict timing, that his thesis maturity was enough to overcome the chaos of short-term price action. This is what high IQ does in trading. It gives you the tools to be precisely wrong. You're not making amateur mistakes. You're making sophisticated mistakes with complex reasoning behind them. And that's more dangerous because you can't see them as mistakes. You see them as the market being irrational, or volatility hunting your stops, or just bad timing. The market doesn't care about your reasoning. It only cares about one thing. Did you manage risk properly? And smart traders almost universally manage risk poorly because they're managing ego. Here's the pattern I've seen dozens of times. Smart trader learns about trading, consumes mountains of content, understands concepts faster than most, builds a strategy that looks great on paper, starts trading real money. First few trades are careful, small, by the book. Then they hit a losing streak, 3, 4, 5 losses in a row. And here's where intelligence betrays them. Instead of sticking to the system, they start analyzing what went wrong. They dive into the data looking for the flaw. They find something, maybe the entry timing, maybe the market conditions. They tweak the system. They feel smart for optimizing. But what they've actually done is curve fit their strategy to avoid the specific losses they just took. They've reduced their sample size of trades to the point where statistics become meaningless. And they've trained themselves that the system isn't trustworthy, that their real-time intelligence should override the rules. Within weeks, they're not following any system. They're trading based on what feels right in the moment, justified by whatever technical or fundamental reason their smart brain can construct. And they're losing consistently, while convinced they're on the edge of figuring it out. So here's the question. If intelligence is the problem, what's the solution? Should you lobotomize yourself? Trade drunk? Obviously not. The answer is that your intelligence isn't the problem. How you're deploying it is. Think about it this way. A Formula One race car is an engineering marvel, hundreds of horsepower, precision handling, built for speed. But if you try to drive it through a crowded city street the way you drive it on a track, you're going to crash. The car isn't the problem, the context is. Your intelligence is the Formula One car. Most of life is the racetrack. Trading is the crowded city street. You need to drive differently. Let me introduce you to David. Successful lawyer, sharp as they come, used to winning arguments through logic and preparation. When he came to trading, he was losing $3,000 to $5,000 a month for almost a year. Not because he was stupid, because he was arguing with the market the way he argued in court. Then something clicked. He stopped trying to be right about the market and started trying to be profitable in the market. Sounds like the same thing, but it's not. Here's what he did. He took his intelligent brain and gave it a different job. Instead of using his intelligence to predict what the market would do, he used it to design a system he could follow without thinking. Instead of analyzing every price move, he analyzed his own behavior patterns. Instead of trying to outsmart the market, he built rules that would protect him from his own intelligence. He created a checklist, not for market conditions, but for his mental state. Before every trade, 3 questions. Am I following my plan? Am I trading my system or my opinion? If this trade goes against me immediately, will I be okay with the loss? If the answer to any question was no, no trade, no matter how good the setup looked. His intelligence was now working for him, not against him. He wasn't trying to predict, he was trying to protect. And within 6 months, he was profitable. Not because he got smarter about markets, because he got smarter about himself. This is the shift. Your high IQ becomes an edge when you stop using it to outsmart the market and start using it to outsmart your own psychology. Here's how to do it. First, redirect your pattern recognition. You're going to find patterns no matter what. That's how your brain works. So instead of finding patterns in price, find patterns in your behavior. Track your trades, not just the outcomes, but your mental state. Were you confident or desperate? Patient or impulsive? Following your plan or freelancing? After 50 trades, your intelligent brain will see the patterns, and they'll be real patterns, not noise. You'll notice you lose money when you trade in the first hour of the session. You'll notice your best trades come when you're slightly bored, not excited. You'll notice you break your rules after 3 winners in a row, not after losers. These patterns are gold because unlike market patterns, you can actually control these. Second, use your intelligence to build systems, not to override them. This is critical. Your smart brain is exceptional at design. Use it there. Spend your intellectual energy building a trading system that accounts for every scenario. What's your entry criteria? What's your exact stop loss? What's your position size calculation? When do you take partial profits? When do you hold for runners? Document everything. Make it so clear that someone with half your IQ could follow it. Then, and this is the hard part, Follow it yourself without adding your superior judgment in real time. Your intelligence designed the system when you were calm and objective. Trust that version of yourself more than the version trading with money on the line. That version is emotional, biased, and desperate to be right. That version is not smarter. That version is compromised. Third, redefine what right means. You're smart, so being right matters to you. Fine, keep it, but change the definition. Right is not, my analysis of price direction was correct. Right is, I followed my risk management plan regardless of outcome. Right is, I took the loss when my stop was hit even though price came back later. Right is, I walked away when I was tilted instead of forcing a trade. See, intelligence loves measurement. So measure the things that actually matter. You followed your system on what percentage of trades? You kept your risk per trade at 1% or less. How consistently? You stayed out of the market when your setup wasn't present. How often? These are the metrics intelligent traders track, not whether they predicted price correctly. That's amateur hour. That's ego disguised as edge. Fourth, embrace simplicity as sophistication. This is the hardest one for smart people. Simple feels dumb, but in trading, simple is survival. There's a trader named Alex who manages 8 figures now. His strategy is absurdly simple. He trades one pattern on one time frame with the exact same risk on every single trade. He takes about 100 trades a year. Win rate is barely 50%, and he's consistently profitable year after year. I once watched him explain his strategy to a room full of traders. Half the room looked disappointed. "That's it?" one guy asked. "Don't you analyze fundamentals, news, multiple time frames?" Alex just smiled. He said, "I used to, when I was losing money." The guy who asked was a financial analyst at a hedge fund. He probably had an IQ 20 points higher than Alex. He was also still struggling to be profitable trading his own account. Simplicity is not stupidity. Simplicity is intelligence that's been refined down to what actually works. Every complex system you build is just more opportunities for your smart brain to interfere, second-guess, and optimize yourself into losses. Strip it down. One setup, clear rules, consistent execution. Let your discipline be the sophistication, not your analysis. Now, here's where we turn your intelligence into an actual edge. Because once you stop using your IQ to fight the market, you can start using it to dominate the mental game. And that's where smart traders become dangerous. Think about chess. A high-level chess player isn't thinking harder during the game. They prepared before the game. They studied patterns, built systems, planned for scenarios. During the match, they're executing, not innovating. Trading is the same. The thinking happens before you trade. The execution happens during. And smart people, once they understand this, are built for the preparation phase. Here's your edge, step by step. Step 1. Systematic preparation. Use your intelligence to prepare for every scenario before you're in the trade. Not just entries and exits, but emotional scenarios. What will you do if price goes against you immediately? Not, "I'll see how I feel," but exact rules. If price hits X, I do Y. Every time. No exceptions. What will you do if you're up big and start feeling invincible? Exact rules. After 2 wins, I reduce position size by half on the next trade. Or I take the rest of the day off. Whatever the rule is, decide now, not in the moment. What will you do if you have 5 losses in a row? Stop trading for the day, the week? Review your journal for 2 hours before taking another trade? Decide with your intelligent, calm brain. Then follow it with your emotional, trading brain. Smart traders who do this become almost robotic. And that's the point. Robots don't let ego interfere. They don't revenge trade. They don't move stops.
Step 2. Deep self-analysis. Here's where your intelligence becomes unfair. Most traders can't or won't analyze themselves honestly. They blame the market, the broker, bad luck, anything external. You're smart enough to see through your own BS. Use that. Every week, review your trades. Not whether you won or lost, but whether you honored your system. When you broke rules, why? What were you feeling? What story did you tell yourself to justify it? This is hard work. It's uncomfortable. But your high IQ means you can spot patterns in your behavior that others miss. You can see the subtle ways you self-sabotage. You can identify the specific market conditions that make you trade emotionally. Most traders can't do this level of introspection. You can. That's your edge. Step 3. Probabilistic thinking. Smart people understand statistics. Use that. Trading is not about being right on any single trade. It's about having an edge over hundreds of trades. If your system wins 55% of the time with a 2-to-1 reward-risk ratio, you're profitable. Even when you're losing, you're executing a winning system. Your intelligent brain can understand this. Let it. Every loss is just a data point in a larger distribution. Every win is the same. You're not trying to win today. You're trying to execute enough trades over time that your edge expresses itself. This mindset protects you from the emotional roller coaster that kills most traders. You're not devastated by losses because you understand variance. You're not overconfident after wins because you understand sample size. This is high-level thinking that most traders never reach. You can start here. Step 4. Become a meta-learner. Here's the final edge. Smart people are good at learning. But in trading, what you learn matters more than how fast you learn it. Most traders study the market. You should study traders. Read every interview, biography, and psychological study you can find about successful traders. Not for their strategies, those probably won't work for you anyway. For their psychology. How did they handle losses? What rules did they create for themselves? How did they manage tilt, overconfidence, fear? What mindset shifts separated their losing years from their winning years? You'll notice patterns. Successful traders aren't necessarily smarter than you. They're more disciplined. They're more honest with themselves. They respect the market's unpredictability instead of trying to conquer it. Learn from that. Your intelligence lets you extract lessons from others' experiences without having to blow up multiple accounts yourself. That's a massive edge if you use it. Let me leave you with one final story. There was a trader named Robert. PhD in physics, worked at NASA, literally a rocket scientist. When he started trading, he approached it like an engineering problem. Built complex algorithms, multi-factor models, sophisticated risk calculations. Lost money for 3 years straight. He was about to quit when he met an older trader at a conference. The guy had been profitable for 20 years. Robert asked him about his system, expecting complexity. The trader pulled out an index card. On it were 6 rules: entry, exit, position size, max daily loss, max weekly loss, and one line that said, "Trust the system, stop thinking." Robert was almost offended. "That's it? That's too simple." The old trader smiled. "You're smart enough to know better, you're just not yet smart enough to know how dangerous that is." Something clicked. Robert went home and simplified everything. One strategy, clear rules, no real-time optimization. He gave himself one job: follow the rules. Not improve them, not adapt them, Just follow them. Within 6 months, he was profitable. Within 2 years, he'd made back everything he lost. He retired from NASA and now trades full-time. I asked him once what changed. He said, "I stopped trying to be the smartest person in the room. There is no room. There's just me and my rules. And my rules don't care about my IQ." That's the shift. Your intelligence is not your enemy, but it becomes one when you use it to outsmart yourself. The market doesn't reward smart. It rewards consistent. It rewards disciplined. It rewards honest. You have all the intelligence you need to succeed in trading. You probably had it on day one. What you might be missing is the wisdom to know when not to use it. Build your system when you're calm. Follow your system when you're trading. Analyze your behavior when you're reviewing. That's it. That's the whole game. Your high IQ is a weapon. The question is whether you're pointing it at the market or at yourself. Point it at yourself, at your discipline, at your psychology. That's when it becomes an edge. Stop trying to outsmart the market. Start building a system you can't outsmart. That's how smart traders finally win.